last part, we introduced the basics of the yield curve. Now let's look at its main shapes and what they mean for investors. The curve typically takes three forms: upward sloping, flat, or inverted. An upward slope signals long-term rates above short-term rates, often a sign of healthy economic growth. A flat curve suggests narrowing spreads, reflecting uncertainty about the outlook. An inverted curve, where short-term rates exceed long-term rates, has often preceded recessions in history. Investors can adapt their strategies to the curve's shape. For example, when the curve is inverted, long-term bonds may offer relatively attractive returns, making it sensible to extend duration. In a steep curve environment, bank stocks usually benefit as their net interest margins widen. Corporations also adjust financing decisions, choosing when to borrow and at what maturity, to avoid locking in costly long-term funding when short-term rates are high. It's important to note that the curve's movements are driven not only by economic expectations, but also by monetary policy, market liquidity, and global capital flows. That's why interpreting it requires context, not mechanical rules. Understanding the logic of the yield curve helps investors spot risks and opportunities ahead of time.